Inflation indices are higher all over the world, with consumer prices in the US jumping 5% in May, the fastest pace since 2008. China rose 1.3%, South Korea hit 2.6%, and Singapore rose 2.4%, the fourth consecutive month in positive territory. Global commodities integral to economic growth, including corn, oil, and copper, now cost twice as much as they did a year ago. How will this impact global economic recovery? Welcome back to our very special edition of the Money Mind Exchange, where we're talking about the investment landscape for 2021, the second half of it. In the last segment, we were talking about the risk of inflation. James, you mentioned it. How concerned are you about this continuance of what we're seeing with inflationary pressures, and should people be adding it as part of an inflation risk in their portfolios?
Well, I think it is clearly a risk, and I think investors have to think it through various scenarios. But I think the base case is one that inflation is something that's temporary. But nevertheless, I think there are a few broad trends that you could observe. In places, in countries that are recovering the strongest, inflation is actually the strongest. And I think that's a good sign because it's a lot to do with pent-up demand. But it's also very clear that if you look further out ahead into 2022 or beyond, that pent-up demand, whether it's for travel or services or consumption, it's going to peter off. It's going to stabilize for sure. But of course, in the short term, there could be a lot of volatility. You could get high readings in inflation. You can get very volatile readings. And therefore, I think investors also have to prepare, just in case that inflation gets out of control, at least for the short term, to put in inflation hedges, such as getting exposure in equity portfolio to inflation hedges and sectors, such as financials or even materials, to just get that hedge, at least for the short term.
Vasu, do you agree with James?
I agree, James. I think inflation is, in our view, it's also temporary, it's transitory, and I think, but the fact of the matter is that it is a risk. It is a risk to the extent that it's playing on the minds of investors. It is feeding through to the headline news. It is worrying global fund managers, it's worrying investors, they're on the edge. So it's going to cause market volatility. So you can't run away from the reality. I think investors have to be prepared for that. And secondly, the second point I'd like to make is that as the economies recover post-pandemic, as we open up, economies recover, it's only natural for inflation to pick up. Investors cannot expect inflation to remain at the current low levels.
Angela, there will be other factors as well that will influence the markets. I mean, part of those rising prices has been because of the disruption that we've seen with supply chains. And we've also seen so much economic heat between the US and China, but there is this big political chill. So do you think we're going to continue to see disruption in terms of those trade disputes as well? How will that weigh on this year's performance?
Yeah, that's a great question. So definitely watchers that looked at the market and said, when we have a President Biden, the US-China relationship will improve, were wrong. And we knew that. We predicted that way back when, that if you're sitting it from the U.S. perspective, the idea that the U.S. needs to be tough on China and is viewing China through the lenses of very serious strategic competition, that is not. That's the single bipartisan issue right now in U.S. politics. So that's not going to change. I think what's different in this administration, you're seeing this then play out with investments, is it's not trade, it's tech. So yes, there's still a little bit of conversation around trade and tariffs, but for the most part, it's tech. And so you're seeing things like the Senate just passed the $250 billion bill to invest in U.S. R&D as it relates to tech, to invest in the domestic semiconductor industry. And so ways in which the U.S. can improve their ability to come to the table with tech leadership.
Vasu, when you look at the performance on Wall Street, and we take so many of our cues from just how well Wall Street is doing or not, it's a question of, how hot, is it hot enough? And then it gets too hot. And so we're already beginning, as we always do, begin to talk about, well, could we see a correction? Corrections could lead to something more like a crash. Should we be concerned about that?
I don't think we are headed for a crash. Corrections are normal. If you look at 2020, we had a bull run in the stock markets. The MSCI World Index went up very significantly, as you said. But during that 2020 period, there were 3 periods when the markets pulled back by between 6% to 8%. But that pullback did not signify the onset of a bear market. It signified a breather, and after the pullbacks, the markets resumed their uptrend. So I think investors have to expect the fact that with exceptional gains we've seen so far in the last 15 months, pullbacks are normal. Nobody can sprint forever. right? You need to take a breather, you need to catch your breath. And so the markets need to catch their breath as well. And so that will happen. Corrections, volatility will be the new norm. I think the second thing is the easy money has been made. We've had almost 90% appreciation in global equity markets in the last 15 months. Now, investors cannot expect that sort of momentum to continue going forward. Valuations are not excessive at this juncture, although markets are at a record high, but neither are they cheap at this juncture. So essentially, the gains going forward are going to be more modest, and it will be accompanied with more volatility. But we don't think that the bull market is over.
COVID, of course, has shown, and pandemics have shown that now that is a big risk that companies are looking out for, and the manner in which companies deal with those risks. I was going to mention to you this survey by Visual Capitalist, which found that the threat of a pandemic outbreak climbed 15 spots, 15 places, to become the second most significant risk to business. First one, of course, being business interruption in and of itself. So is now a strategy for handling a pandemic going to be a must-have for business, Angela?
Absolutely. But alongside that is what we're calling the complacency risk. So we're seeing a lot of companies say, we got this. We lived through this pandemic for the last 18 some odd months. We know how to do that, so we can kind of rest now with our risk management. And that is not the case, because the next thing that could be a pandemic, it could be something completely different, climate-related disaster of some sort, climate event, et cetera. So I think the key we're seeing for risk management in general is just having a really good read of what the potential risk factors are, not in general, but for your very specific sector, your business, your operations, and then having a real-time feel for that, right? We're seeing an increased interest in predictive threat intelligence monitoring, 24/7 follow the sun, global capabilities to identify and deal with those risks. And so it's kind of that, keep your finger on the pulse, because next time actually probably won't be a pandemic. It'll be something else.